Annuities. An annuity is a contract you make with an insurance company. You give them a lump sum of money or a series of payments over time, and they promise to pay you back a regular income sometime in the future. This can be a steady paycheck for a set number of years, or even for the rest of your life. It's a way to create a reliable income stream in retirement. Your money grows tax-free until you start taking withdrawals. And since some can provide income for life, you don't have to worry about outliving your savings. However, annuities can have ongoing administrative costs. They can have high fees and penalties if you take your money out too early. And when you take money out of an annuity, the earnings are taxed first before you get back the money you originally invested. Also, your money might not grow as fast as it would in other investments like stocks. Money market funds. A money market fund is a type of investment fund that invests in high-quality, short-term debt securities like U.S. Treasury bills, commercial paper, and certificates of deposit. It's considered a low-risk investment. You can usually access your cash quickly, and they often pay a higher interest rate than a regular savings account. But unlike a savings account, it's not insured by the FDIC, so there's a tiny risk of losing money. The returns are typically low compared to other investments such as stocks and bonds. 401k? A 401k is a retirement plan offered by your employer. You can have money automatically taken from your paycheck and put into the plan before taxes. And a huge bonus, your employer often matches your contribution, which is essentially free money. And your savings can grow without you having to pay taxes on them until you take the money out in retirement. However, you usually can't touch the money before retirement without paying penalties. Your investment choices are limited to what your employer offers, and some 401k plans can have administrative and investment management fees. Individual retirement account. An IRA is a personal retirement savings plan you can open on your own. You have two main options, a traditional IRA and a Roth IRA. In a traditional IRA, you may be able to deduct your contributions from your taxes in the year they are made, which can lower your current taxable income, and the money in the account, including any earnings, grows tax deferred. But you will have to pay regular income tax on withdrawals in retirement. As for a Roth IRA, you contribute money that you've already paid taxes on. In return, all your withdrawals in retirement, including all the money it's earned, are completely tax-free. You can also withdraw your original contributions from a Roth IRA at any time, for any reason, without paying taxes or penalties. However, withdrawals of earnings are subject to specific rules, and a Roth IRA can be passed to your heirs, and their withdrawals can also be tax-free if the account has met the 5-year rule. However, there are income limits that may affect your ability to contribute directly to a Roth IRA. 529 plan. A 529 plan is a tax-friendly savings plan to help you save for education costs, like college tuition and even K-12 expenses. You can put money in it for your kids, grandkids, or even for yourself. The money you put in gets to grow, and you don't pay any taxes on the growth. And when it's time to pay for college, you can take all that money out completely tax-free, as long as you use it for things like tuition, books, a computer, or even room and board. However, this plan is for education only. If you decide to use the money for something else, like a new car or a vacation, the government will hit you with taxes and a penalty on the earnings. Futures. Imagine you're a farmer. You know you'll have a bunch of corn ready to sell in 6 months. But what if the price of corn drops by then? To protect yourself, you can make a deal today with a company that buys corn. You both agree. I'll sell you 1,000 bushels of corn on October 1st for $5 each. That promise is a futures contract. It locks in the price and the date, no matter what happens to the market later. The company is guaranteed a price, and you're guaranteed to sell your corn. There are two main reasons people use futures. 1. To protect themselves. Big companies use these contracts to lock in prices and avoid surprises. This is called hedging. 2. To make money. Investors use futures to bet on which way they think prices will go. Because of something called leverage, you can control a huge amount of an asset with a very small amount of cash. If you guess right, you can make a lot of money very quickly. However, if you guess wrong, that same leverage can cause you to lose big. Futures trading is extremely risky and requires significant knowledge and experience. It's not like buying stocks where you can just hold on to them forever. Futures contracts have an expiration date, so you have to be right, not only about the direction but also about the timing. Forex. Forex, short for foreign exchange, is the act of buying and selling different currencies with the goal of profiting from changes in their exchange rates. Professional traders try to predict if one currency, for example the US dollar, will get stronger or weaker compared to another, like the Japanese yen. If they think the dollar will get stronger, they buy dollars and sell yen, hoping to sell the dollars later at a higher price. The Forex market is enormous, making it easy to buy and sell currencies, and is open 24 hours a day, 5 days a week. Similar to futures, Forex trading often involves high leverage, offering the potential for significant profits. If you're right, your profits can be massive. But if you're wrong, even by a tiny bit, your losses can be just as huge, and you can lose all your money and sometimes even more. Because of this, Forex trading is incredibly risky and mostly for professional speculators. You need to be an expert on things like economics, global events, and interest rates just to have a chance. Royalties and intellectual property. Imagine you could own a tiny piece of a famous song. Every time that song is played on the radio, streamed online, or used in a TV show, you get a small payment. That's a music royalty. Or maybe you own a piece of a patent for an invention, like a new kind of battery or a special type of plastic. Every time someone uses that invention, you get a royalty. A successful investment can provide a steady stream of passive income. It's a way to diversify your portfolio away from traditional stocks and bonds. However, it's hard to figure out how much this type of investment will be worth in the future, and it can be difficult to sell if you need cash quickly. Also, you have to protect your investment, and that often means lawyers and contracts, which may cost you money. Cat bond. Whenever there is a massive hurricane or a major earthquake, insurance companies have to pay out billions of dollars in claims. To handle this risk, they use something called a catastrophe bond, or cat bond for short. Think of it like this. An insurance company goes to a group of big investors and says, "Lend us a ton of money, we'll pay you a really high interest rate every year. But if a super specific giant hurricane hits a certain area, we get to keep your money to pay for all the damage." Essentially, investors are getting paid to make a high-stakes bet that a major disaster won't happen. Because you're taking on that risk, you get paid a much higher interest rate than on a normal bond. And since cat bonds are independent of the stock market, they are a great way to spread out risk in a portfolio. But if that major specific disaster does happen, like a Category 5 hurricane hitting Florida, you could lose some or even all of the money you invested. Franchise ownership. Instead of starting a business from scratch, you buy the right to use a famous brand's name and business model, like Burger King or McDonald's. You're basically buying a ready-made business kit. You get to use a well-known brand and business model, so it can be less risky than starting a business from scratch. Also, the main company usually provides training, marketing materials, and ongoing support. But you'll pay a big initial fee just to get started, and then you'll have ongoing payments of a percentage of your sales to the main company. Also, you have to follow the main company's rules. You can't just change the menu, paint the walls a new color, or decide on your own promotions.